Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today we're talking US shale. Its phenomenal growth over the last 15 years has contributed as much as 10% of global oil supply, had profound effects for the US economy, and it itself has gone through significant changes in that short period. What are those changes? Where is shale today in terms of participants and contribution? And what is the outlook? Is shale going to disappear as quickly as it came, or will it continue to be an integral part of the global oil supply chain? Our guest is Matthew Bernstein, manager of Shale Analytics at Rystad Energy, the independent energy and analytics advisory firm. As always, you can really support the show by leaving us a positive review on the platform you're listening on, and I hope you enjoy the episode. Matthew, welcome to the show.
Thank you, Paul. Pleasure to be here.
Right, so we are talking shale, focusing primarily on oil. Obviously, we're talking from US shale, and essentially leading up to the question about whether it is in terminal decline or it can meet the requirements and needs of a growing global energy demand over the next decade or so. That's a long road to get there, and I want to kind of take advantage of your experience and understanding to build a picture of what's gone on in the shale industry over the last decade, because it's gone through some profound changes. So let's sort of start in early 2010s. Production has started, technology has proven, wells, big land grab going on, and you sort of described that as shale 1.0 or 1.5. Can you give us some sense of the broad sweep of the characteristics of that shale market then?
This is really that kind of boom and bust, short cycle, high growth, high investment shale business model, which really made the U.S. the number one producer of oil and gas in the world, and really, the shale revolution, if you will, as it, it was correctly characterized, where this new hydraulic fracturing and lateral drilling technologies were able to unlock all these hydrocarbons that really kind of flooded the global market. So, if you think about, the investment in a shale well, as opposed to an offshore development or just kind of onshore conventional, really these are short cycle investments. You're able to drill many wells in a short period of time for a relatively low capital investment on a per well basis. So, these aren't, 20, 30 year long, development cycles like you would see in other supply sources. So really, these wildcatting shale firms, both public and private, a lot of public companies starting up in this time in the Permian, of course, in the mid 2010s. And, even before that in the Barnett and Eagleford and some of these other areas. And really just a lot of capital being invested to unlock this resource, because you're able to drill these relatively low cost wells that have a really steep and quick production profile, where you're able to get a very quick payback time, and then have that quicker decline period. So really this shale 1.0 to 2.0, these are terms that we've been using here at Rystad more in the context of where shale is today and its more mature state, but really that being the advent of the industry and then the massive growth of the volumes in the early to mid 2010s. So yes, it was characterized by very rapid production growth, but really just a lot of consistently negative years of free cash flow. So, there was really this promise to investors that we have these quick payback wells and we're going to drill a lot of them and get a lot of revenue. But of course, when prices then suddenly became lower, that's something where, a lot of the CapEx quickly dried up and then quickly shot back up when prices got higher again. So, really it was this industry of companies that were very responsive to commodity prices. And it's really kind of, I guess, what made shale these marginal barrels on the global scene, where it was a very highly cyclical source of hydrocarbons. So if you think of the operator mix in that too, so like I said, you have these private E&Ps, and then a lot of private equity backing, but you also have a lot of public E&Ps. A lot of them are these kind of, traditional wildcatting firms, companies, XTO that was eventually sold to Exxon and Chesapeake, and some of these firms that were really, started by these, real kind of oil men and real legends of the industry, if you will, and really kind of believed in this technology and believed in this business model. And, again, it really was characterized by this high growth and this big surprise, I guess, on the, both in terms of domestic energy in the US, but also in barrels on the global scene. And that's really what characterized that time period. But more importantly, at the end of the day, it's a business. And, as we look into kind of the late 2010s and especially going into 2019, this was a period where these companies were effectively free cash flow negative for a decade plus. So really not producing a lot of returns to their investors, and not really having that cash to return. And that was really, I guess, kind of the first chapter in turning the page and into the next era of the industry.
It's difficult to describe the scale and impact of the 2010s. Just if you fly from Houston to the West Coast, you just see it's landscape after landscape of little square patches of concrete, which all of which have a well on, previously had a well on that stretches all the way through, New Mexico and so on. I mean, it's profound. So the 2010s, and we had David Port on a couple of years ago talking about sort of the private equity's role in this, and really, as you've characterized, it was negative free cash flows, but people were making a lot of money essentially proving acreage and then flipping it. And that's a fascinating story about actually who walked out of that with the money and who didn't. And fair to say, a lot of banks and a lot of investors didn't. Just sort of putting a pin in 2019. At that point, and this is, I always feel this is somewhat forgotten in the American economic story when we're contrasting why the US has continued to double its GDP over the last 20 years or whatever it's been versus Europe. I mean, part of it is because they effectively found two Saudi Arabias and exploited it over the last 14 years or so. But we put a pin in 2019, sort of before we get to Shale 3.0. How consequential was shale to the world market? What percentage of that barrels a day was it contributing? Keeping on oil here, can you just give us some sense of that?
Yeah, I mean, looking, I guess, kind of in the mid 2010s there, you have effectively going from a legacy declining supply source in the United States, and a lot of that being, these old conventional Texas fields, the Gulf of Mexico and Alaska, to kind of, I guess, maybe go in a bit of a different route on your question. I'll get to it, but you think about, everybody wants to figure out why our how can we make our unconventional formation, or how can we make our shale rock formations, or shales, other kind of different types of rocks out there, how can we unlock that same hydrocarbon potential that the United States has. And, to be completely honest, outside of Canada and Argentina, really, there hasn't been that success. And, it really is in that sense. And of course, probably a whole different podcast for that, about the companies and the kind of entrepreneurial spirit of the technologies that were built here in the US, and the regulatory environment and things like that allowed for that to happen, that really you haven't seen it happen in some of these other places where you have these kind of state controlled energy companies and similar things to that. But getting back to your original point, so in 2010, the United States was producing about 5.5 million barrels per day of oil. This is oil and condensate volumes, but not NGLs, so not total liquids. And in a matter of the 2010s, roughly, so from 2010 to 2018, all of a sudden, you're averaging almost 11 million barrels per day in 2018. About 10.97 is what we have in our data, and really hitting that all-time high in 2019 at again, this is at an average annualized basis. You're hitting monthly highs in that time, and daily highs, of course, but at about 12.3 million barrels per day in 2019. And when we get back to, I guess, the more recent years, that's a number that we've surpassed since. You consider about what's shale doing now, but really just, that US supply source going from, more than doubling, and thinking about all those incremental barrels, about 7 million barrels incrementally being added to the global market between 2010 and 2019 in just less than a decade. So again, to your point, it's just a massive contribution on the global supply source. And you can see how and why that impacted OPEC, and impacted demand, and everything in the way that it did.
That's, shorthand, 100 million barrels a day consumption. So we're talking 7 to 12% of global demand met by shale in that period, which is, as you say, enormous. Okay, so the story then, the Shale 3.0 is sort of 2019 onwards, which is essentially, and you're going to describe it, characterized by consolidation, a new suite of capital rich participants, and an absolute focus, free cash flow, discipline. So, can you describe that to us, and how that has changed shale and what it has meant for production?
Really, I think COVID era kind of brought this into the laser focus, but even before that, like you said, in 2019, that really was the year when external financing really kind of started to dry up a lot in the business. I mean, you look at that, you're almost kind of a decade or more into this shale run. You have prices that are relatively stable for oil, but at the same time, you don't, it's not 90, it's not $100 a barrel. You're kind of, you've had all this resource that's become economic with the improvements in lateral length, and all of these kind of capital efficiencies. But still, you're not generating free cash flow, because the investment required to continue to deliver that same production, so to drill the same number of wells, or the amount of wells required to maintain production, is just so high. So really, you have banks taking a step back, and saying that, hey, this has made a huge impact on the global energy landscape, and the geopolitical landscape, and global economic landscape. But that's not really what's important for us. What's important for us is getting a return on our investment, and you just weren't having that for the public companies. There was not enough cash that was being generated to underpin this business model of high investment.
Just to jump in there, just from the people side, right, was when 2018, 2019, all of the reserve based lending, upstream oil and gas banking teams were being sort of gutted here in Houston. This soon gets amplified by ESG in sort of starkly, really, in the COVID times. But it was pretty rough. And it's fair to note as well, right, that you go back a couple of years and there was lots of management teams from various oil majors or whatever it might be, from shale producers, splitting out on their own, getting financing in, lavish offices, ready to sort of redo the acquire some acreage, prove it, and flip it, right? I mean, it was, the music stopped quite suddenly, is what I'm trying to say.
Yeah, no, and I think if you look at the overall kind of societal factors, I mean, yes, there was this push in this, pre-COVID and going into COVID era of really a lot of investment in kind of energy transition technologies, and a focus, like you said, on ESG. And of course, these things are still, I think, salient in the market. But of course, since 2022 and the Russian invasion of Ukraine, there's been a kind of renewed focus on energy security and whatnot. But yes, in this time, exactly, it's a combination of factors. So you have this kind of push on the capital side to, I guess, do less business, if you will, in oil and gas. And at the same time, you just frankly have a subset of companies that aren't making money. So, it's kind of it was really a tough time in that period where a lot of cards were, for both faults and not faults of their own, a lot of cards were really stacked against these E&Ps here. But really, what came out of that was a leaner, healthier industry where you now have, or you had in the years that followed, really a laser focus on returning cash to shareholders. So with these debt raises and this external capital drying up, basically these E&Ps had to learn how to live effectively within their operating cash flow. So really you see reinvestment rates plummeting from almost 200%, and to take a step back, reinvestment rates being the ratio of capex to cash from operations. So basically, how much of your new investments are you paying for with cash that was generated from your operations? So really, you have reinvestment rates, falling below 100% in this time period, which means that you're actually having cash that's being held onto after you're spending on new investments. So in other words, you're free cash flow positive for the same time, operating profit minus capital expenditures. So that cash then in turn was used for a multitude of reasons, but primarily, one, to pay down existing debt, and two, to finally pay back those shareholders. So you see dividends increase, you see buybacks increase, and you really have this new business model where your case as an investment, as a company, your value proposition is that you are going to be able to return to generate significant cash from operations almost regardless of the oil price, at least in a stable oil price environment, to underpin these returns that you're giving these shareholders. At the same time, in terms of consolidation too, and we'll get to the present day consolidation, but in this time you really have consolidation more for your kind of industrial logic, economies of scale reason, really for leaning up these companies, realizing operating synergies and things like that. Again, how can you take these assets and squeeze the most cash out of it? And of course, COVID then really forced these companies, maybe not all of them that were doing it, and some of those companies went out of business, but really tightened the belts, and really made sure that this business model was applied throughout the public side of the industry.
Yeah. So you have the Conocos and the Oxys and so forth, essentially in this period able to buy some of these firms for a song because, it was COVID. The ESG story was big. They were negative cash flows. So those guys can come in, they apply that cash discipline. They also have the way I guess I think about it is you go from kind of a real estate flip
Yeah.
mindset to getting rent mindset,
Yeah. Well,
and
yeah,
these guys have the technological capability to apply
exactly.
things like AI, obviously the expansion in lateral drilling that we're about to talk about. So they are, it's a very different business model in terms of extraction, and also as well they have quite significant commercial arms, that are able to maximize the return on the selling side as well.
Yeah, and I mean that's something we'll touch on, where you're really even seeing that more nowadays in, I guess, the Shale 4.0, if you will, where you're getting these large independent public firms with global operations, with, exactly like you said, other business arms, and really able to put this acreage to use in a much different way. But excuse me, going back to this earlier period, and it's important to preface with this, is that what sets apart 4.0 from 3.0, so kind of where we are today and where we've been over the past year, past 9 months, from the period before that, is really you still have the last kind of remaining semblance of the earlier eras of the shale industry, and that is still the private operators. So you still have a lot of private equity capital in the market. So especially as publics were looking to be more of this, have more of this kind of capital discipline mindset. The reason that volumes still, I guess, kind of recovered from COVID to the same degree that they did, was because you still have this these private equity groups looking for deals as acreage is kind of being sold for a discount as those companies are going out of business, and really still this kind of more entrepreneurial wildcatting mindset where you're developing acreage, you're buying acreage maybe more on some of the fringes, and really starting to develop that. So there's almost these offsetting factors during this time where on the public side you have these companies going out of business, going bankrupt, frankly, during COVID, and also consolidating again for these economies of scale reasons. But again, at the same time, you have these private E&Ps that are, or these private equity groups that are launching new portfolio codes during this time. So really, it's a quite interesting analysis that we did here at Rystad, where we looked at it's effectively a proxy count, but the number of active individual companies in the US lower 48, of course, that's a number that's drastically increasing during the 2010s. And that actually really stayed flat during the kind of 2019 to 2021 period, because you're having these offsetting effects between publics merging, publics going out of business, but at the same time, still a good amount of these private equity groups starting up. And frankly, that's why you saw during this time period in the recovery from COVID, you have publics really targeting, I mean, what? uh, Flat to very slight growth during this period, but at the same time, you still have um, 700 million barrels per day growth in the United States in oil volumes in 2022, and just under a million last year. So, you're still having these privates growing at 20-30% year on year, growing their volumes at that rate, while, publics are growing 0 to 2.5%. And that, as we get into the story of today, is something that's shifting. But I think it's important to kind of characterize this Shale 3.0 period where you still do have a bit of this cyclicality to prices, especially as they shot up in 2022.
Yeah, okay, so it still has that responsiveness available then. So maybe I jumped the gun a little bit, but so Shale 4.0 today, can you sort of characterize that? And perhaps let's start with the number of participants on your index.
Yeah, exactly. So, we estimate that roughly in 2024, the number of active companies has fallen by almost 20% from 2021. So again, it's all of a sudden you have almost kind of consolidation for good, if you will. And that number for 2024, that still includes companies that were active for a portion of this year. So, Callon Petroleum, even Pioneer, Crown Rock, Endeavor, some of these larger scale deals that have happened. So that number is almost surely to be lower next year. And what that tells me is that the acreage, especially the good acreage, is being so consolidated by these large group of public independents and super majors that really, even private equity firms that are maybe looking to get back into the mix, you're left to more kind of less proven areas, if you will. But I guess taking a step back there, and the Shale 4.0, it's a term that I started using after the Exxon Pioneer rumors first broke last October, so almost a year ago, and really thinking about how that deal would and how it has changed the industry, and that really being the kind of firing gun of we're going to be having large scale consolidation by the largest players, and all the knock-on effects, that entails with then mid-sized public independents needing to secure their share of the pie. But really, it's a complete recharacterization of the shale industry. And going back to what I was talking about, at the beginning of this conversation, about this very kind of entrepreneurial, wildcatting spirit and mindset, and all these players, hundreds of them in the what there's still hundreds, but much more of the acreage has been controlled now by a much fewer amount of companies. But all these various kind of fragmented group of companies that really set the United States apart from other countries where you have one, two, three, maybe a state controlled major entity. These are in the US, you had this diverse group of operators working in their own economic interest, and you still have that, but just it's really the corporatization, I guess, of the industry, where now we estimate that in 2024, and you'll have to assume for a second that Conoco, or that Chevron and Hess deal has closed, which of course it hasn't. Neither has ConocoPhillips and Marathon, but of course that's a whole other podcast that one could talk about the Chevron Hess deal. But nonetheless, where assuming Chevron Hess is one company, Exxon Pioneer is one company, and Conoco Marathon is one company, we estimate that roughly a third of the remaining tight oil resources in the United States lower 48 are controlled by the super majors plus ConocoPhillips. And to put that in perspective, that number was about 10% in 2010. So really a dramatic shift in who controls what in the industry. And even if you look at the next group of companies, so your Diamondbacks, your EOGs, your Oxys, companies like that, in the Permian, those top six combined firms, so that's Exxon plus Pioneer, that's Chevron, that's EOG. This isn't in order, but that's Conoco plus Marathon, that's Oxy. And those firms and Diamondback Endeavor, of course, those firms control roughly, we estimate, about 2/3 of the remaining Permian oil resources. So really, the knock-on effect of that is, if you are a mid-cap, if you are a other public independent there, you need to effectively be able to secure the inventory and the acreage to make yourself competitive, not just in a per well economic sense, but in a long-term perspective sense, with these large companies that have diverse capital budgets, that can allocate capital from other regions to the United States, that have natural hedges in their commercial business arms, as you alluded to. And really, if you think about this business model that's underpinned the shale industry over the past 5 years, which is, sufficient cash flows to generate these returns to shareholders. As we're dealing with an industry with a finite resource, and you're dealing with more of that resource being consolidated by companies who have different business models than a public shale, an Exxon has a different business model than a Matador or a SM Energy, or a pure shale player. If you are these pure shale players, you need to be able to ensure that you can deliver your returns to shareholders, not just this quarter, not just next quarter, but 10, 20, 30 years from now. And that's really why we've seen this type of consolidation. And at the same time, you've also seen a bit more of kind of investor flexibility on things like going out and raising new debt. So we've seen debt levels rise to recent year highs, actually, in the recent quarters, because you're using your cash on hand, you're going out, you're getting new debt in order to finance these acquisitions. So in a way, deal making and debt raising is, well, of course, deal making, but debt raising is really kind of back on the menu, but not in the sense of we're going to use it to spend all this money on this kind of new organic program, but really for the means of growing the business through inorganic acquisitions.
The HC Insider podcast is brought to you by HC Group, a retained search, intelligence and advisory firm focus solely on the global energy and commodity sector. With 6 locations across Asia, Europe, and the Americas, and over 50 consultants. To find out more, go to our website, hcgroup.global. There, you can also sign up for our HC Insider content for more interviews and white papers on relevant trends and talent impacts in the commodities world.
What has all this meant for production? Where are we at today? And I guess allied to that is, I'm trying to get this sense of how shale's responsiveness, it sort of being that marginal producer, how that now might change. And then we'll come on to sort of the future and try and sort of tackle that burning question about, which has come up multiple times in this podcast, about whether actually shale can continue to contribute to global supply as it does today. And if it doesn't, what happens then? But let's start with that. What is that, as you look at today, what's shale production and how has its responsiveness to the market changed?
Yeah, great question. So the United States oil production is about, based on our latest numbers, around, 13.2 million barrels per day in August 2024. If you look at just the lower 48 states, so excluding the Gulf of Mexico, excluding Alaska. So, of course, there's still kind of a conventional wedge in this, but it's, close enough to thinking of what we think of when we think of shale. So lower 48 onshore, that's a little over 11 million barrels per day. So, when we were talking about numbers earlier and that US number surging past its kind of pre-COVID highs there, it's taken a lot to get back up there. But in terms of who's driving this growth, that's what I see as kind of the biggest change in the industry is even in the past few years in the Shale 3.0 era, as I mentioned earlier, you're having these private E&Ps driving this growth and that's really if I had to point to one thing that maybe sets Shale 4.0 apart from Shale 3.0, there's a whole host of things, but the biggest difference is really that these private E&Ps are losing their sensitivity to the prices because if you're having these companies sell for a 5-6x EBITDA multiple, which has been occurring over the past year, that's very attractive either for a private equity group or even for some of these non-private equity operators that founded by some of these real oil men. That's an attractive exit, and it's very hard to pass up on that. So you're seeing a real premium in the market, not just for private equity and not just for private operators, but for private operators with acreage in the best of the best. So again, thinking of the past year, that's your Endeavors, that's your Crown Rocks. And as a result, you're seeing these kind of two forces of one, companies almost doing the public's bidding for them in reducing their rig count and reducing their activity prior to acquisition, because right now you're not getting your multiple based on your current production, you're getting your multiple on how much inventory you have, because that is what, going back to this long-term resource potential maximization, that's what these public E&Ps are after, is that long-term inventory. So you're having private rigs really, staying under control, even as prices have been relatively high this year. I know that, of course, we're under $70 WTI now, and there's been this bit of a downturn. But overall, throughout this year, we've seen prices in this, range around 70 something, $80 a barrel. Privates are the whole cost curve is not the whole, most of it's commercial at that level, but you're still seeing subdued drilling activity, both from the publics and the privates. And then for the private E&Ps that have been acquired, when that is transitioned into the public operators portfolio, you're having that acreage developed in a much different way, where all these hallmarks of the public E&P business model, low reinvestment rates, capital discipline, a focus on returns, that's being applied to that acreage that's being acquired. So you're seeing the same land developed at a less rapid pace, and a pace that focuses on long-term maximization rather than short-term returns. Now, to take a step back, If you look at this though, and again, that was maybe seems a bit negative in terms of the production story. However, you're getting a shift in who's contributing the volumes. So at the same time as you're having the impact of these private E&P programs become less, you're seeing the super majors and these large companies actually have quite ambitious programs on the assets that they're acquiring. So the most obvious example is Exxon acquiring Pioneer, because again, for all those reasons that we talked about, with if you're a super major, if you're a large public independent with international operations, so even an Apache, an Oxy, you don't have to blow out your corporate budget and have your corporate reinvestment rates be very high in order to grow your shale volumes. You just need to reallocate capital from other areas to the US lower 48. And that's what we're seeing. So, really, in the medium term, it's almost these offsetting effects of you're having lower private E&P output, but at the same time, you're having these large public independents who are controlling more of the inventory, operating it in a way where they have natural hedges, they have geographical diversification, and frankly, if you're an Exxon or a Chevron, you have the absolute inventory where you can grow 10% a year and still have decades worth of inventory. So it's really a recharacterization of who's producing what.
And you have there's a technology angle here as well. AI, I mentioned, the ability to exploit these wells more efficiently. You have that picture in the medium term, and who knows what disruptions come up and stuff. I mean, there's always a giant earthquake somewhere in West Texas and the whole thing shuts down, right? Like, there is this sort of narrative I just kind of want to nail as best as possible. You sort of have this one suite of the sort of the heuristic judgment is actually, wow, these things are depleting much more quickly than we expected. There isn't an ex Permian, and we could find ourselves in 5-10 years without with significantly lower shale production. The entire US economy, and I'm expounding this view, the entire US economy has been sort of rooted for cheap gas. They haven't invested in renewables in the same way that Europe has. We just did an episode on how Europe might be on the other side of that hump now. And, that would be quite a catastrophic picture. It'd probably be quite good for climate change, but it certainly wouldn't be good for the economy for, where I'm sat right now. What's the probabilities of that being the case? Are we seeing anything about surprising declines? No new fields available. How quickly are we chewing through these reserves and what that might mean?
Exactly. I think that in the industry, there's really not in the industry as in shale, but in the the market and the discussions that are happening. There's kind of two camps here, where there's the one you just mentioned, and then there's other industry analysts and other people, especially abroad, and who are seeing U.S. oil production at all-time highs again, and operators continue to beat guidance and being like, wow, this thing is back on its footing. Productivity is at all-time highs, production's at all-time highs. Shale is going to continue to be this massive supply source. And frankly, Rystad Energy's view and my view is that it's a much more nuanced picture, and there's almost a bit to be said in support of both sides, and really it depends on where you sit. So let's start there. So if you're an E&P management team, if you're an investor, if you're an equity research analyst, you are laser focused on per well results. And that's where you start to see some of these declining productivity numbers. You start to see companies kind of depleting their best inventory and moving to higher break even wells and things like that. So that shift is happening. We've really seen, on a lateral normalized basis, we've really kind of seen really a stagnation in productivity growth for some years now. However, if you look at it on an absolute basis, so a non-lateral length and normalized basis, you are seeing productivity at all-time highs. But really, that is a factor of a increased concentration of drilling in the most economic areas, and even within basins, the core of the core, if you will. So, if you look at overall U.S. production and overall U.S. shale well productivity, it's really due to a proliferation of activity in the Permian and in the most core regions of it. So, on a lateral normalized and on a regional normalized basis, you're not seeing productivity at all-time highs, but still you're seeing it at stable enough levels where there's no data to point to anything about it falling off of a cliff. So really, as I alluded to, the inventory is still good. It's still, it's still commanding these multiples that we've seen in the market. And if you look at it again on a completely unnormalized basis, it's at all-time highs. So again, really a lot of people's views are biased, naturally by where they sit, what type of data you're looking at on a day-to-day basis. But really, it helps to, I guess, add some context to what for some seems like a kind of a discrepancy where you're having, you're hearing about inventory depletion, but you're also seeing US oil at all-time highs and things like this. So now in the long run, of course, a per lateral productivity is important because you're not going to always maintain that cost efficiency where you're able to drill wells cheaper on a per lateral foot basis.
You literally mean kind of some drill sticking out sideways and how much oil it's
Yes.
is
Yes. So
generating.
the horizontal distance of the well, effectively. So, if you think of a shale well, you drill downwards and then you drill horizontally. And that's kind of one of the parts of the shale revolution and that technology. But of course, the longer you drill a lateral, you're extracting oil from rock that can't be extracted from another well. So, when these operators, there's conversations on how best to maximize your resource potential, because if you think about on a per well basis, the longer you drill those laterals, the more production, the higher productivity you're going to get. However, that might not be the best for your long-term inventory life and your valuation, and the same thing goes for spacing. So how far apart are these wells that you're drilling within the same pad, within the same area? Because if you drill them very close together, you're maybe getting more efficient well productivity there, but you're also drilling up more of that land that could be drilled at another time. So I guess kind of returning back to the original point here, our view is that you will have this kind of this stagnation on a per well basis is real, but at the same time, productivity for these wells, especially in the Permian on an absolute basis, is at still very strong all-time high levels, and it's not going to be falling off of a cliff.
And that's a function of now who's got the reins, right?
Yeah,
These
yeah,
one final question, and I guess this is probably quite hard. So to recap the previous one, it's not anytime soon, right? I think is sort of
yes, yes.
the reality there, and you've got a maturation in the technology, a maturation in the participants, and you've got sufficient there to carry on at least probably for the life of the energy transition, which is we keep saying is a whole other podcast. The sort of in the immediate short term, you have this rumbling from OPEC about are they going to potentially flood the market with extra barrels, fight for market share, and kind of the possibility of reverting to the sort of 2014 when you had the last oil price wars with an explicit intent to try and kill off shale in its cradle effectively. Is that a potential? And now, given this shale sort of 4.0, are these current operators as vulnerable to that kind of move as they used to be? And are we likely to see any effect? I mean, I'm kind of asking, at what point does it all stop? Now you've got Shale 4.0.
I mean, a lot of that, of course, depends on, well, goes without saying, but depends on the price, depends on the eventual oil demand and speed of things like an energy transition on, or lack thereof. And kind of how long does oil demand, stick at its hot, does it grow more, whatever else. I think the most important point is that these companies are a lot less price sensitive than they used to be. And really, I mean, in terms of when does shale start to operate at a lower level than it does today, I mean, I think really you'd have to see prices under $70 a barrel for a long period of time, and really under 62. But that would kill off maybe a bit of the, or not kill off, but it would limit the activity of maybe a bit of the, some of the private operators that are out there, and maybe bring growth rates for public from 6% to 1% or something like that. But really, for these super majors, for these large public independents, I mean, they have attractive acreage, they have commercial acreage, and really, as long as prices stay in that range of 60 or above, I mean, you're going to continue to see the same sort of operations that we've been seeing. And even on the flip side, you can see up to $90 a barrel without things changing much. So again, it's really this page where you're not going to have these kind of rapid movements on price swings. And I think that shale has become, well, maybe without directly answering the OPEC question, I think that one thing that I think that a lot of these players outside of the US realize is that shale has become a much more predictable supply source. So, the reason that things went the way they did in the 2010s was that, it was this big swings in terms of this highly cyclical short cycle source where, production would boom, production would fall, and it was all very dependent on the swings in the price. Now you've seen both shale production and then frankly you've seen price be quite stagnant over the past few years, or at least as far as shale production goes, be quite decelerating, or quite within a range bound area. So I think nobody's under the illusion that you're gonna have public independents growing 20-30% per year anymore. And like I said, there's just not really the same salience of private control of the acreage, to, even if they wanted to have private growth as big of an effect on the overall barrels coming out of the ground as it has in the past. So really, I think that companies have become much more telegraphed with their plans, and much more kind of, I think, confident in their strategy of what's going to be coming out of the lower 48. And to kind of wrap things up, shale is still going to be growing, at least for the rest of the decade, but it's become that growth is decelerated from what it's been, and it's become it's still a prolific but a much more predictable supply source than it's been.
And as such is now kind of an integral part of global oil supply,
Exactly. Yes.
as opposed to sort of this sort of wildcatting marginal barrel that, yeah. Well, fascinating, Matthew. It's been really interesting having you on. I hope to have you back on in a year or so, and we can see where this story is at. But I definitely wanted to tackle it because it's something that just keeps sort of coming up as to, especially now when we've got LNG exports on the horizon from the US, and much of that gas is really associated gas, and if the oil price falls too low, that's not going to flow. And it is a complex picture out there, but it's fascinating to see that change. And I'd refer listeners to go back and listen to the David Port episode, I think, with private equity's involvement in the energy sector, where he really leans into this. And I think the phrase Houston Shell Game or Houston Shale Game comes up. But anyway, let's leave it there. It's been a real pleasure having you on.
All right. Well, thanks so much for having me on, Paul. It was a pleasure, and yeah, look forward to hopefully joining again in the future.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify.
To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world.
There you can also find more content, from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.